Hey everyone, the stock market is acting crazy. It's been dropping super fast and it looks like we're going to finish 2018 at a loss for the first time in 9 years. I want to show you how to protect your wealth and even grow it through market crashes. All right. Now, many are calling this the beginning of one of the largest market crashes we've seen. But is it? We're going to discuss that. We're also going to discuss what's going to happen with Bitcoin if the market does crash. Now, I started investing in one of the worst market recoveries or market crashes we'd seen in 1995. I invested through two more market crashes in 2000 and 2008. So I have some experience in this. So let's jump in. Let's see how you can protect and even grow your wealth through market crashes. So stay tuned. Hey, welcome back. So today we are going to talk about the market crashing. We know there's a market crash coming at some point, but when is always the question. Now, everybody can see the fundamental reasons why it's going to happen, but when, right? And so let's talk about that. Is the top already in? Are we in the middle of a crash right now? Is there more to come? And more importantly for us, what's going to happen with Bitcoin? Where will we be able to move our money to keep it safe and even grow it through a crash? So let's talk about this. So first of all, is the stock market crashing? Now, obviously the prices are down. There's no denying that. But does this mean we are going straight down from here, or is there more room left? Now, of course, we'll never know when the top was until we're looking back on it, just like we don't know when the bottom is until we look back on it. Now, at this point, the market is down. As you can see in the chart right here, it's down quite a bit in just the last 3 months. So obviously looking backwards, it looks like it's down. However, we don't know if there's going to be a new top in yet. So let's talk about that. So first of all, as I said in the intro, 2018 is looking to be the first year in 9 years we'll have a loss. I don't think it's going to recover in the next couple of days. So most likely that's going to be the case. So this 9-year streak is going to be over. Now, there's a lot of reasons to be afraid of this. Like I said, there's fundamental reasons why we know this market's going to crash. This massive expansion of debt, the student loan bubbles, the auto loan bubbles, all of these things. The bull market is really old. It's 9 years, one of the longest bull markets in history. We know it's getting tired. Obviously, uncertainty is high. We have, economic sanctions happening all over the world, unrest in the Middle East, U.S. and China trade wars, all these things, geopolitical risks. And then we have the Federal Reserve, who's those artificially lowered interest rates to stimulate the economy, and now they're raising rates. So all of these things create this uncertainty and certainly give us plenty of reasons why the market should go into a correction. However, like I said, how do we know fundamentally what's coming, but how do we know when? And like I said, we don't. So what we do is we look at the signs. And it's kind of like if I said, hey, we're going to drive, to this location, and I have these directions to get there. What I do is, as I'm driving, I'm looking for signs. And when I see this sign, I know I turn right. When I see this sign, I turn left. And so that's kind of what we do. We look for signs, and that tells us how to react. We're not trying to predict the future, but rather we're going from indicator to indicator. So if that makes sense, kind of like we would look for direction. So when I'm driving, I'm not going to predict the future of where I'll be, but I know when I go from indicator to indicator which direction I go, and that eventually leads me to where I want to go. So what we're going to do is look at a couple of indicators. There's a bunch that we can look at. I'm going to take a couple. We're going to strip away these worries, strip away this uncertainty and doubt, and we'll just look at facts. We'll look at these important indicators. Like I said, I can't go through all of them. There's probably about 10 that make up good indicators in my opinion. We're just going to take a look at a couple of them. So the first one, if you've been paying attention to these financial markets, you've probably heard about bond yields and this inverted yield. And maybe you don't know what that means, so I want to explain this to you. Now, first of all, I'm going to go through 3 indicators. I'm going to give you a very simple explanation of this because I need to get through it quickly. I can't really get into too deep, otherwise it would take too long. So leave me comments if you want to know more about any of these specific things. Of course, give me likes if you're liking this content so I'll know to give you more of that. Now, the bond yields are one of the main indicators. Like I said, it's been all over the news. And there's a couple of yields. There's a 3 and a 5 year yield, which has inverted already, but that's not really the one that we're looking at. We're looking at a 10 and 2 year bond. And when they cross over, that means that there's going to be a recession ahead. So you can see in this chart right here, there's kind of an example, and you can see the bonds going up and down. So when they cross below the black line where the red star is, that means we're going to be heading into a recession. So it's been pretty accurate. This has been one of the better indicators we've had, and it's flashed ahead of every market peak for the last few decades. It's almost perfect. It's not perfect, but it's almost perfect, and that's why we don't go off of one indicator. We go off of a bunch of them. We want to see all these indicators having this kind of a consensus about this, but this one's been near perfect. It's never missed a market top before, and what I like about this indicator is it's a leading indicator. So some indicators are lagging, so they kind of tell us what happened, but we want to find leading indicators which tell us what will happen, right? So this one has been almost perfect. It's called every top, and basically as soon as the 2 and 10 year flip, then that on average gives us 12 to 18 more months of good times before the market really starts to crash. And so this hasn't. It was looking like they were approaching and they were going to invert, and now they've kind of backed off. And so this is just one indicator. Again, it may or may not work. However, based off of history, it's been very accurate, and as soon as it flips, then we know we have 12 to 18 months before we hit this major crash, and it hasn't done that yet. Now, the next one is we look at unemployment numbers. Now, this is another chart. The gray lines show us different recessions, and you can see when the unemployment numbers drop. So, of course, as you might imagine, falling unemployment, you may not imagine. In this case, falling unemployment is good. That means we want employment to be high. We want the economy to be good. We want jobs to be happening. So when unemployment is falling, that means people are working. And then, of course, rising unemployment is bad, right? I'm sure you hear that in the news. It's been a big political agenda. Now, I was gonna say a side note, but I'm not gonna do that. So the right here, the gray bars, like I said, represent the periods of recession. And so you can see how when the unemployment is rising, it corresponds with each of those recessions. And you can see when unemployment drops, it's not in the recession period. Now, unemployment in the US has been falling for many years. It peaked at about 10% back in 2009, and today it sits at 3.7%. So unemployment has been falling, and historically unemployment rises going into recession. It doesn't drop going into recession. Now, I will say as a side note, these numbers are manipulated. This is the actual numbers that we get from the government that they report. However, what it doesn't account for is how many people are working part-time, how many people have decided just to give up on working altogether, how many people are working like gig jobs, on Upwork and Fiverr and Uber and things like that. So I don't believe these numbers are as accurate as they can be. However, this is the data that we have to go off of, so this is what we have. And again, one indicator isn't everything. We look at a bunch of indicators together. And of course, the bond yield, which we just talked about, is one of them. Unemployment's another one. And then another one we look at is the leading economic index. And so this one is a group. There's this independent group, this conference board, and they take 10 different economic indicators across a bunch of different spectrums, everything from employment to housing to interest rates, and there's 10 different economic indicators they look at, and then they put them together into their own kind of reading. And this one right here has an amazing track record, and part of the reason why the track record is so good is because they are taking data from 10 different indicators instead of just one, right? And it's had an incredible track record of predicting recessions. The chart right here that I have on the screen shows a year-over-year change of the leading economic indicator. So every recession for the past 50 years happened the year-over-year percentage change when it went negative. So when the LEI index goes negative, we see a recession. Now, again, like I said, this is an extremely accurate indicator because it combines 10 indicators together, so it's more reliable. It's actually, it's only given us one false signal before, and right now it shows positive economic growth. And again, we've only, over the last 50 years, we've only gone a recession when it's gone into the negative, but right now we're in a positive economic growth. So there's 3 very strong indicators that we look at to say that the market may not be over. There may still be some room to run. Now, of course, we don't know. We just look at the signs as we go along, and this is kind of what they're telling us. So using some of that data, is the market in? Well, based off of this chart, you can see that the market is starting to drop, and it's dropped pretty rapidly. It's dropped pretty deep, and so maybe we are going into bear market. Our job as investors is not to guess and not to tell the future, but rather to be prepared for any scenario. So because we don't know, we just want to continue to watch. We want to continue to watch these signs, and we want to be prepared for either scenario. Now, the question I brought up at the beginning of this is, how is Bitcoin going to hold up? All right, if we have this market crash, if we have maybe the biggest market crash we've ever had, how is Bitcoin going to hold up? And of course, we don't have that answer because Bitcoin is so new that we've never gone through a market crash. So we're basically in this 9-year bull market in stocks, and Bitcoin is about 9 or 10 years old. So we haven't really seen that. As you can see from this chart, this is the last 10 years in stocks, and they've basically gone straight up. So we don't really see what Bitcoin can do through that. However, what I'm going to do, because we're going to try and answer this question, is that we are going to compare it to gold. Now, Bitcoin is called digital gold. I'm sure you've heard that. If you haven't, it's called digital gold. The reason why it's called digital gold is for many, many reasons. First of all, Bitcoin was designed to be like gold. So gold has backed every major currency for the last 5,000 years, and it makes a very good store of value for a number of reasons. I have videos on this, but really quickly, there's a limited supply. The more you get out of the ground, the harder it is to get more. There's a true cost of capital, so I actually have to spend money in order to get the gold out of the ground. There's all these reasons, and so Bitcoin was kind of created the same way, where eventually it has a limited supply. Eventually will run out. The more Bitcoins we get out, the harder it is to get more. There's a true cost of capital. I have to buy equipment, electricity, and so forth. So Bitcoin makes a very good digital gold. And it's also important to understand that the reasons why somebody would want to buy gold are really the same reasons why somebody would want to buy Bitcoin. All right. So the reason why people want to buy gold is what we call a chaos hedge. So they know that fiat money, government money, is fake. It's just printed out of nothing. And they know that it's constantly being printed more. And as they print more money, it inflates the money supply, making all the money weaker and weaker. Eventually, all fiat currencies will end up at zero. We know this through history. We see it happening all over the world in other countries. I haven't seen it in the developed countries yet, but eventually I think it'll come. So what happens is, people want to hedge or protect themselves and put some money in physical gold because it's been around for 5,000 years. It's been money for 5,000 years. So they want to get out of fiat. They want to have a little bit of exposure to gold to protect themselves against inflation. So it's a good hedge against inflation. It's hard to confiscate. Obviously, if all your money is in a bank, it's very easy for that for someone to push a button and to freeze your account, to seize your account, to steal, manipulate your money. With gold, it's very hard to do that. Of course, they could come to your house and put a gun to your head, but it's a lot harder to do that than it is if you have your money in a bank. Also, it holds value over time. Now, some of you guys may not really understand that, but it does. It holds value over time. Now, if you look at it compared to dollars, it doesn't look like it's been holding up because the dollars are being inflated, which means they're being worth less and less. However, the same amount of gold in, say, 1950 would really buy about the same amount today in gold, not in dollars. And I have videos talking about this, so I'm not going to go in deep into that. Now, of course, if you have questions about this, you want me to go in deeper, leave comments below, leave the timestamp so I know exactly what you're talking about. And again, if you like this content, give me some likes on this. I appreciate that. And I love to have discussions in the comment. All right, so now that we went over all the reasons why Bitcoin is like gold, a digital gold, let's look at how gold has held up, right? If we understand the reasons why people bought Bitcoin are the same reasons people buy gold. And by the way, gold, physical gold, is an $8 trillion market. That's pretty big. So I expect a big portion of that 8 trillion to come over into Bitcoin. Now, how has gold held up? So that's what we'll look at. Again, people buy it for the same reason. So this is a chart of the last 5 recessions we've had back in the 70s, and we can compare gold to the S&P 500, which is the large stock index that we look at. And so again, like 5 recessions in the last 40 years, and 4 of the last 5 recessions over the last 40 years, gold has been an amazing hedge towards stock market. So let's take a look at this in detail. I'm going to go through it really quickly. Again, give me comments if you want more detail. Now, 1973, we had a crash. Now, this is important because 1973 was the end of the Bretton Woods Agreement. Hopefully you know what that means. I've talked about it before. The Bretton Woods Agreement is when the US dollar would be backed by gold and all the currencies of the world would be pegged to the dollar. In 1971, President Richard Nixon took the United States off of the gold standard, and by 1973 is really when the end of that Bretton Woods standard ends. And then we had this oil crisis at the same time. Now, this uncertainty between the dollar and oil at the time led to a big market decline. And as a matter of fact, you can see on this chart right here, the stock markets over this period from 1973 to 1974 had dropped almost 50%. So the stock markets dropped 48%, almost 50%. And during the same time period, physical gold went up 140%. So one went down by half, by 50%. The gold went up by 140%. So you could see during that 2-year period, it would have been a great idea to move from stocks into gold, ride that back up, okay? Now, the next one is 1980. Again, some of this was kind of the same thing. This was a second oil crisis. There was a lot of instability in the Middle East at the time. A second oil crisis. The production really kind of shut down. They started this Iranian revolution, which then led to the Iran-Iraq war. And so this decreased in production because of the war led to this oil crisis. And you can see, again, from the chart in 1980, the stock market dropped from 1980 to 82, so over a 2-year period, it dropped 64%. So a 64% decline over 2 years, and gold also dropped. So gold dropped 46%. So in this particular, this was one of 5 that gold didn't hold up. Gold actually dropped along with the market. However, it dropped less. So even though it didn't completely protect you, you lost less money than if you would have been in stock. So not exactly what we're looking for, but at least you lost less money. Now, the next one is the 1987 crash. And this one was after the 80 crash, the market had rebounded really hard, like it typically does when it gets into an oversold situation. And so from 1980, from that crash until 1987, the market had rebounded 230%, which is a big number. And so the market had been doing really good, but then it got into, it was kind of priced too high. And then at the same time, more oil concerns. Again, lots of instability in the Middle East. Oil concerns happened, prices dropped. The price of oil dropped more than 50% in 1986. Then in 1987, tensions around oil kind of increased. Iran started firing missiles at American oil tankers. And as you can see, it had a horrible effect on the market. And the market had dropped 34% in 1987. So the market crashed 37%. But gold went up by 6%. So again, 34% loss if you had kept your money in stocks, and you would have made 6% if that money was in gold. So another good one. Now, then we have the 2000 crash, and in 2000 was the internet bubble, right? So that's one that we talk about a lot. I've talked about a lot of crypto, Bitcoin enthusiasts talk about it because it was kind of the most comparable one to where we're at because it was a technology cycle. And I've talked extensively about technology cycles are different than investing in any other asset class. I have a video about that in the Wealth series, so go to the playlist and check out the Wealth series for more on that. But I'm not going to dive any deeper than that. Leave me comments if you want me to get in deeper on that. Now, the 2000 crash, again, was the internet bubble ran up. Now, a lot of that was a new technology cycle, but it was also heavily funded by debt. And then the market crashed. The money got ahead of the technology, and it crashed, as we know. And as you can see in the chart here, the market overall, the S&P 500 dropped 50%, another 50% decline. But gold had a 12% increase. So again, half your money would have been completely lost if you were in the markets, but you would have made 12% on your money by being in stocks. It actually got so bad, the final nail in the coffin, as I put up here, was the 9/11. So that happened in 2001, and that really just drove home the pain in the markets. The New York Stock Exchange shut down all trading for several days, so it was really bad, and you would have lost 50% of your money in stocks, but gold, you would have made 12%. Now, The last one that we have to look at was the 2007 to 2009 crash. That was the most recent. Most of you guys are probably more familiar with that one. And that one was really a banking crisis. That was, the subprime mortgages. And it started as just like a banking crisis, but really it developed into an international banking crisis because all the banks are sharing debt with each other. And really we saw this massive group effort of all the central banks around the world to really try and bail out the banks, reinflate the bubble, and so forth. And the stocks, as you can see in this chart, the stocks dropped 57% during that period. So you would have lost over half your money, almost 60% of your money during the same period. Gold went up by 26%. Now, if you look at just a small, I want to make a side note on this in case a few of you are wondering, because this is, if you look at just a short period, gold actually dropped pretty fast too. So when the markets dropped, everything plunged off a cliff, and gold also plunged off a cliff. However, that's if you're only looking at like a very, very short period, but gold rebounded sharply. So while stocks still continued to fall, gold was back up. So yes, gold did drop, but it quickly rebounded, and over the period that we're discussing, 2007 to 2009, gold outperformed stocks from a negative 60% to a positive 26%. So that is history, that is fact, and that is what how gold and the markets have historically gone. So just to give you a real quick recap here, you can see the red and the green. The red is when gold didn't keep up with the markets on a decline, and the green is when it does. And so based off of this, it shows that gold has historically been a good way to hedge against market crashes. And again, I made the case that Bitcoin is digital gold, and so because of that, I believe that Bitcoin should hold up very, very well. Now, a lot of people are thinking as soon as the market crashes, everyone's going to Bitcoin and it's going to be the new money supply. It's not going to happen like that. I hate to break it to you. Hopefully you weren't planning on that. It's going to take decades for that to happen. The trust isn't in Bitcoin just yet. And just like the money doesn't automatically go to gold either. Now, gold's $8 trillion, but it doesn't mean that everyone just leaves fiat and goes to gold either. So Bitcoin is going to take a few market cycles to really start to get that trust and that attention. And really it's going to take multiple generations. I know like my mother-in-law still goes to the grocery store and writes checks. There's a lot of people that still don't like to get money out of ATMs because they're just old and they didn't grow up with that. And so it's going to take, like my kids will probably be 100% on cryptocurrencies and will never use traditional banks. And so it's going to take a couple generations, it'll get there. But overall, I think it's going to be a great place for us to hedge against this market crash that's coming. Now, the market crash, 2019 to 2020 to 2021, when is it going to happen? Like I said, I made the case based off of the three indicators I reported on that the market crash may not be here yet. We might still have some more room. However, it doesn't change the fact that it's coming. It's going to come, and it's going to be very, very severe. So my whole point is I want to just let you guys know that it is coming, and I want to make sure that you're prepared for it. Again, like I said, I always tell you that I would want to know, or this, I'm telling you what I would want to know if I was on the other side of the table. I've gone through a few recessions, and I didn't always get out so well. As a matter of fact, you've heard me say before, I lost almost everything, or I did lose everything in the 2008 because I was all in on real estate, and that just wasn't the place to be. I didn't know about this diversification principle. So let's talk about that, and what can you learn from my past mistakes to make sure you don't do the same thing. Now, we know the crash is coming, we don't know when. So we want to stay in the markets because we still want to get some upside. All right. Now, if you want to get it completely out of risk, you can just get out of the market right now, move to cash. One of the Rothschild family, I forget which one, Baron Rothschild, I think, and someone asked him, like, how has your family been able to hold wealth for this long of a period? And his response was, I always got out a little bit early. So not trying to be greedy and squeeze the last bit out, just get out early, and so you can do that. However, that's not what I'm doing. So I'm staying in, but I have a good strategy, mainly around asset allocation, and that is the way that you divvy up your assets. I'm going to keep some in stocks because I still want to ride this up if it's going to be going up, but I want to make sure I'm hedged in other things in case it goes down. Now, if you want to know more about asset allocation and exactly how you can set your portfolio for success, look in the description down below. I have a link, and you can download a guide for free that I put together to teach you how to do this. It teaches you how to think through this, and it's important for you to understand how to think through this because it's going to change for you throughout your life. So as you get older, as you make more money, less money, if you retire, things like that are always going to affect your allocation strategy. And so I can't tell you how to do it, but I can tell you how to think about it. So download that free guide down below. You'll really find it helpful. And it's going to give you advice on percentages, diversification, and it's going to talk about different types of assets that you can invest into. Now, of course, you want to go into non-correlated assets. That way, if one goes down, the other goes up. So to hedge against stocks and things like that, bonds, as I demonstrated, gold is really good. I think Bitcoin is going to be really good to do that. You can also hold on to cash. If the sale of a lifetime is coming, you have that long-term perspective. Having that cash, we call it dry gunpowder, would be really good to buy into some of those special deals. And then you can include other assets. So I like income-producing real estate. I'm a huge fan of that. That's my end game personally. If you want to know more about income-producing real estate, leave me in comments below. I have a lot of experience with it. It's something I really love to talk about. Also, tangible assets, things that you can buy and hold, real physical things. Alternative fixed income investments, and then also one of my other favorites is direct investments into cash generating private businesses. That could be starting a side hustle. That could be buying stuff to sell on eBay and Amazon. That could be investing into other small businesses, or it could be a catering business or something like that. So you could always consider things like that. Now, that's it. That's how I'm looking to protect myself for the pending crash that's coming. We don't know when, but we do know it is coming. So I'm being prepared. Let me know how you're going to be prepared. Let me know if you're going to be hedging in bonds or gold or stocks, and you can just put one word, say like gold or Bitcoin, right? Let me know how you plan to hedge on that, and leave me any other comments below. I love to have discussion. I love to answer every single comment that's in there. Give me likes if you like this, so I know what kind of content you like. And that's it. This is my last video for the year for 2018. 2019 is shaping up to be a great year. So see you next year. To your success. I'm out.